Representative Paulsen.
Thank you, Mr. Chairman. Actually, I think some of my questions will be able to allow some of that same line of thought to occur. I was going to ask just regarding the issue of the impact of the Fed's policies on savers, on seniors, for instance, and maybe that some folks in who are of higher age category they're not making wise asset allocations, for instance, and they may be pushed more towards riskier investments because of declining interest rates. And I know that Chairman Bernanke, back in February of 2013, just recently, he just testified actually that he said the notion that savers are harmed by the Fed's current policies aren't really a factor, because he's argued that as much as there's harm to interest-bearing accounts, savers are also benefiting from other assets like stocks and real estate. He noted that the stock market has doubled in the last few years, and he's expressed conviction that the economy must move forward and pick up steam before interest rates are brought back up. So it kind of follows, just to follow up, what is the proper balance for U.S. monetary policy in terms of achieving that price stability and lower employment in a way that does no harm to American savers or to seniors who choose to forego present income for future security? And maybe Dr. Taylor, you can kind of start off, and we can, Dr. Paulsen.
Well, I'd say one way to look at this is to just go back to the 80s, 90s until recently. It basically had a policy which would ease in a recession, and it would tighten when inflation picked up. It worked very well. It seems that's the kind of policy you're looking for now. But a policy that says promises zero short-term rate for years into the future, that's an interference with the markets that's very unusual, extraordinarily unprecedented. Don't think this is not unusual. And the massive purchases of mortgage-backed securities, massive, this is not just a few, is very unusual. And those create this uncertainty about how it's all going to be unwound. And the zero rates themselves, they do cause a search for yield. We've seen that in the past. There's also an effort to drive down the long-term interest rates so they don't reflect the information that's coming into the economy, whether it's a pickup or a slowdown. So it's a massive change in policy, and the effect on savers and what they do is just one example of this. So it seems to me we know how to deal with this. We've done it in the past, and I think we should try to do that in the future.
And you suggested that a return to a more rules-based monetary policy would result in normal market-determined interest rates that would reduce those incentives for pension funds and retirees to take on more dangerous risks. So are the Fed's policies right now contributing to a stock market bubble, to a potential housing bubble down the road? Bubbles burst. I mean, is it a contributing factor?
Yeah, one of the problems in economics, we don't know exactly when it's a bubble and when it's fundamentals. I think there's some good things going on with respect to profits. There has been a recovery. It's just terribly weak. Many of the firms you're looking at, their stock prices are benefiting from foreign sales, and the world, especially emerging markets, are doing quite well. And so there's lots of other reasons, more fundamental reasons, but I think you should be worried about bubbles, especially in the fixed income market, and to the extent that the Fed is influencing that, I believe they are, that has to be removed at some time. It can only be temporary. The Fed can't do this forever. We can't rely on the Federal Reserve for the stock market in the United States forever.
Yeah, Dr. Paulsen.
Yeah. Mr. Paulsen, I guess I'm uncomfortable with your initial statement about the Fed should worry about inflation, employment, and no harm coming to savers. The Fed's goal should never be no harm comes to any one group, full stop. That doesn't mean we shouldn't be honest and look at those issues and admit that there are effects and pluses and minuses, as I think Chairman Bernanke tried to account for. But the idea that the Fed should direct its policies towards any one person or any one type of person, I think, is a mistake. To the degree that there are people in savings who have issues, it is a smaller number than sometimes people think for the reasons that have been discussed. But it is also a question of why haven't other assets gone up in value? Why aren't there other interest rates in the private markets moving? The Fed is not directly influencing those assets. And that gets us back to what we were talking about earlier, which is there are limits to what the Fed can do, but that's not the same thing as saying what they're doing is causing these other problems in the economy. And I think we got to make that distinction.
All right. Thank you, Mr. Chairman. You go back.